once again, I'm brschultz. Thank you for joining me for another weekly forecast episode for the S&P 500. Next week is week number 7 of 2024. I produce my videos at the end of every week, so therefore I'm not trying to manipulate or be swayed by any of the market movement. So it is Friday around lunchtime. And what is today? Today is February 9th. Futures, the SPX 500 USD is at 5,010. So right around those highs of the macro peak window that was stated around February 6th, plus or minus 1 day. So that popped us up above the 5,000 mark. So we're still right around that peak level of the prediction, the time frame prediction. I can't say per se that the model hit 100%, but it looks like it's extremely close. But who knows, if markets rocket up later today, that can completely push the top higher. So still a little too early to call the accuracy of the February 6th plus or minus 1 day. So the Great Depression kicks off, I believe, in about 342 weeks. That's when I believe that the stock market will be at a monster peak out near Labor Day of 2030. That's what you see in the background here on the thumbnail of this video. And I have a few very interesting graphs for you today on the Great Depression. I've added those. I try to add maybe one or two every now and then, but I found a few more to add, so I think you'll find those very interesting. So in the least, hopefully you find the countdown to the Great Depression of interest over time, over the next 6.5 years as we march up to the super top in markets out in late 2030, if it all unwinds and plays out according to what the models are proposing. Thank you for joining me. If you haven't subscribed yet, please do. If you enjoy my work, please, by all means, please share my work with others. It's how I grow my channel. So it would mean the world to me if you find my models very intriguing and highly accurate in their forecasts. Please share my work with others on social media sites, with your friends, family, and foes. All right. So for this week, this is the same graph you've seen before. Basically, a very simplistic view with 3 touch points going out to Labor Day 2030. And you could easily say, hey, I think you've doctored this to just go out to 2030. So that's why I have to have multiple graphs, right, to prove my theory and thesis. So this is normally where I start off. Again, the Great Depression, I believe, will kick off in about 342 weeks. So again, for those that don't understand what I mean by that, basically what I'm trying to say is that's where I believe the ultimate peak is, right? So assets and markets would be at their highest point around Labor Day of 2030, and then the drop would occur after that, right? So when I say it starts in 342 weeks, it's basically saying that would be the ultimate peak in markets. And then after that would be the grand fall in markets over the next 4 to 5 years into October of 2035. And I think there will be a double bottom, so I think you'd see another bottom in like 2037. And then I put these little QR codes throughout my graphs and sheets, so I understand that my modeling will take a long time. I try to make these episodes an hour long, so I won't be doing a blog anymore. So I'm trying to get away from the blog. I find that my life becomes so much simpler when I just focus on creating a video once a week at the end of the week when markets are pretty quiet. It helps me kind of center, get my thoughts in line and in order. I can put the presentation together any night of the week I want, or over the weekend. When I have free time at night, I can put graphs together, things of that nature, so I can kind of build my case and my theory for the episode throughout the week. And also, this also keeps me on point, right? Because I'm putting so many graphs in here, so much time in here, keeps all my thoughts aligned. So I don't only do this for the viewer, I also do this for myself. And why am I moving away from the blog? Basically, I want to increase viewership. I want to increase accuracy, obviously, and obviously as hopefully the masses enjoy my work, hopefully it gets to that type of level, that type of accuracy, that type of respect. Hopefully donations will follow, right? And then I will record donations on a tab in this presentation every week over time as donations start pouring in. I think donations are around $100 right now, so I'm not too much. So I don't want to put a slide together yet for that, but when they start reaching a few $1,000s, maybe I'll put a ticker or counter, a weekly counter for donations. And I use Venmo and PayPal. So, all right, let's keep talking about the Great Depression. So this is the Great Depression kickoff as well. Another viewpoint of that. This is, I think, one of my original macro peak models. Essentially, I usually try to take 3 touch points to create a peak in markets. So, for instance, that yellow dashed diagonal line to the left, going up to the top of the graph and hitting that red arrow down in early 2000 or mid 2000, year 2000. It has 3 touch points, so that created the crash from late 2000 into early 2003. And then again, you have another touch point with the black diagonal on the far left in 1978, and it bounces underneath the black wave in 93, 94. And that's kind of like a double bottom because the wave sat there so long, it creates more than 1 touch point. Usually when it's a crisp turn, a very tight turn, it's only 1 touch point. Well, when it kind of sags and sits there for a long time, it's creating multiple touch points in my view, and that leads you to the peak in late 2007. And then you have a few points here. I think this is really beautiful, climbing up the staircase, if you will, the diagonal going out to Labor Day of 2030, starting with the 2004 bottom in the graph. Essentially, it climbs up this imaginary trend line I've drawn, and therefore I believe that you're going to see the macro peak in markets in Labor Day 2030, and then also you have the dashed line on top that's yellow, and you can see the 3 touch points there. So I think there's a strong case there for a macro peak in markets like late 2007 and like late 2000, where markets collapse thereafter. And again, I think the collapse will then carry on from 2031 all the way into late 2035. So I think you'll have a 4, 5, 6, 7 year collapse in markets. And I think that's where all these roads of the financial system weakening, of politicians trying to remove Social Security from future generations. I think it's very clear that they could have restored Social Security and these different social programs very easily, but I believe that it comes with an agenda to weaken America into the Great Depression, unfortunately. So I think this is all intentional. Again, when there's money that goes to different countries for, it seems like very different reasons, and many of them most Americans don't agree with, you would think that it'd be very easy for politicians to completely fill and satisfy the requirements for Social Security to be fully furnished for decades to come. But unfortunately, at this time, it seems that it is on purpose that the Social Security and things of that nature are going seemingly bankrupt. So I think that will hit a pinnacle in late 2030, and then I think that's when the entire financial system in America falls to pieces. And I think it'll be a very challenging and tough time from 2031 through 2035. So you saw this last time. So let's move on to this 1929 graph that I have to show you, as well as the new graphs that I have to show you that I think you're really going to enjoy. If you haven't subscribed yet, please consider it. Thank you so much for following my work. Okay, so this is the MJ23 timing wave, named after Michael Jordan. This is the timing wave that I became very well known for in 2022. I think it called like 55 out of 57 calls correctly on I'm trying to day trade the collapse in 2022. It did really, really well, obviously, with those types of statistics. So the 60-minute model, which is what you're seeing here on a monthly scale, I don't have that in the legend, so I apologize for that. But essentially this is monthly data, and it's on a 60-minute algorithm, what I call a 60-minute algorithm, I guess. And so you can see the 1, 2, 3 touch points, and then it hits the top line in late 2029 or 1929, I should say. And so the whole market collapsed. We had the Great Depression off the Labor Day 1929 time frame roughly. So you can see a nice clear 1, 2, 3 touch point. And so you're wondering, so are you going to say that you're going to show me that same graph for current day? And yes, I am. Again, so if you're thinking that my work is pretty awesome over time, there's no rush. I want my results to prove themselves. I want my work to prove that it's some of the best in the world for market timing and forecasting the future in markets, specifically the S&P 500. If you find it highly intriguing and you want to support my work, show gratitude, please feel free to donate. It means the world to me. My goal is to raise over $100,000 in donations every year. That's my ultimate goal. So that's my 3 to 5 year goal, I should say. So hopefully by 2029, roughly, if my work seems to be highly accurate, that I can sustain my month in, month out expenses and things of that nature, and live off this like a salary. So that would be the end goal if you're wondering what that would be. So thank you for following me. And again, you can scan either one of these and send me a donation through PayPal or Venmo. Thank you so much. So the graph that you've been waiting for is the current day update. So again, this is the 60-minute algorithm for the monthly data, and this is the same algorithm I used for 1929. So you can see here that the model has some really nice touch points going out to Labor Day of 2030. So that's when I believe that the Great Depression will start, i.e. the macro market peak. So if you want to, you can take a snapshot of that, yada, yada, yada. We'll move on to, I think, even a broader view of this graph. Okay, so this is the same graph, and you can see how the model also picks a more flat trend to Labor Day of 2030 as well, at the same exact point in time where the graph is hitting the top horizontal. So again, I think that Labor Day 2030 will be the macro peak in the market, as well as the start of the Great Depression. I think the odds are very high at this point. The setup is definitely there, it would seem, from the monthly data from the early 90s through current. So yes, it takes many years, right? It takes over 30 years of data to set this up. But yeah, so that's where the countdown is coming from that we're talking about into Labor Day of 2030. So again, this is monthly data, 60-minute model on the zigzag model, essentially saying that there would seem to be a pop and then drop in the peak model. So that means that in the peak that we saw in markets in late July, it caused the graph to stick to the bottom of the graph. And then when the market sold off, that's when shorts would increase in value. So that's what happened here. When it pops, that means the market's falling. And then as the market ripped back up here into the Super Bowl time frame, you're seeing the graph pop back down. So I think that's what we're seeing here is it's calling for a macro peak roughly here into the Super Bowl on a monthly scale. So it's a higher level. Obviously, the granularity is not there. That's why I use 1,000 other slides, right? So yeah, that's what this is all about. So this is one of my more favorite graphs. I think this peak model is pretty sweet. I like it at least. You can see that this model called out the peak at the end of November of 2021 when the Fed announced that they were going to start increasing interest rates. So interesting how the model is able to tune in with that suggestion by the Fed before it ever happened. And so then at the bottom of the graph, you can see how it walked up that green trend line. And when that green trend line hit the baseline there, that's when the whole market's bottomed. So it hits macro bottom. So the thought is if you can see a similar trend current day, on both aspects, you could tell that where the macro peak is for markets and the bottom. So again, that's what I believe I'm hopefully doing here. So let's jump to the next slide and show that. I think this is from presentations past, but just to show you that it hasn't really changed, right? Today is February 9th, and you could argue that peak that was originally predicted is right around here, right? So I mean, you could look at the very top of the graph and say, oh, your yellow arrow isn't exactly touching the very top, and the red arrow isn't moved over to touch that point. So you could argue that we're sitting right at that point in time right now here on February 9th. So if the pattern is identical to the peak that happened in late 2021, one might argue that we're at the peak here right around this, where it shows around the February 8th time frame. And again, as you would expect with the macro graphs, it's hard to get it super precise, but still that's pretty precise, right? Saying that the markets would have peaked right around the February 8th time frame. If it were to repeat like 2021, and then you can see at the bottom how that blue, dark blue, bright blue trajectory is going to hit the bottom black line in sometime in October. So my belief is if this graph holds true, that the markets would be hitting their optimal peak here for the year. This would be the final peak for 2024, and then markets would decline until they hit their final bottom in mid-late October 2024. So if you're viewing this in October of 2024, you can come back and look at this and say, wow, that's amazing how that happened. And if it didn't, you can say, well, I guess you missed that one. But you'll be surprised, I think, that we'll see a nice bottom in October 2024 either way. And I have some graphs here that to follow up on this exact point. Sorry, I stuttered there and repeated myself. So this is the purple wave, the MJ23 algo, and you can see the 3 touch points here going out into October of 2024. So I believe that there's going to be a major low in the markets out in October of 2024. I think that will be a major low. I think it could be one of the final lows of the year, obviously. So again, I believe that the markets, the previous graph holds true, that we're hitting the final peak in 2024 here in just before the Super Bowl for 2024, and then the markets would decline for 6 to 7 months into October timeframe, and that would be the final bottom. So it looks like it's picking out roughly just before the election, right? So it looks like whoever's elected, then the markets would enjoy the next 4-year presidential cycle and rip up. So and again, this ties in right with the macro view of the Great Depression, that you would expect that markets would bottom on a macro scale and then rocket up into late 2030. So this is the 2-hour algorithm, and the 26 is basically what I originally had programmed as a 2-hour algorithm. So pay a little attention to the 26 there. But essentially, this is predicting on a macro scale that markets will bottom at the end of mid-October, and that's essentially ties into the previous graph. If you're trying to figure out how this ties in, it basically is supporting the same thesis that markets hit some type of major bottom in late or mid-October 2024. Okay, so I thought this was pretty cool. I made the zigzag model into a 4-hour model, and essentially you can see the touch points I've labeled going into late September 2023 was a major bottom, and you can see that it's already set up 3 points going out again into that mid to late October 2024 timeframe. So I think that's where you're going to see a major bottom, a great buy point, a great time to enter into markets. I'm forecasting, or this model is forecasting for, again, mid-late October 2024. So I have seen that on 3 different models. So I think there's one more model, I think, for October. Oh, never mind. We've covered now 3 models for October, right? You got the first one, and then the second one, now the third one. So I think this may be all of them. I thought I had about 3 of them. So let's keep moving. Okay, so I don't have the label, and this is I think my 2-minute peak model. And I really like this one because it calls out tops and bottoms. And you can look at all the 3 touch points if you want to screenshot this and take the time to look at all the 3 touch points. I think it's pretty cool. Essentially, the green wave, when you take the trajectories off the green wave with 3 touch points, you get bottoms. So you can see how it called out the early January 2024 bottom based on the 3 touch points on the green wave with that diagonal teal blue trend line and the green arrow. And then you can also see how the model is calling for a peak roughly here. That's how it was tying out into roughly February 6th, but you can see, okay, it called that February 7th rocket up, right? So into that 5,000 zone on the SPX500 USD. So you can say, oh, okay, I can give you that. So that's why I kind of need a 2-day window, 1 day plus or minus 1 day. So I'm still trying to figure out if I have the best window for calling a peak. But the February 6th call plus or minus 1 seemed to encapsulate the final melts up. We're hanging out still at that 5,000 mark as I'm talking here. And so also calls out the roughly the March 5th, 6th peak. So it's hard for me to tell you exactly which day, obviously, because it kind of hovers over 2 days. So do I call it a 2-day 100% window plus or minus a half a day? And if I do that, then it's really 4 days. So it's kind of difficult to give you a super tight tolerance, but it's looking like March 5th, March 6th. And I think there's a market holiday in February, so that might bump more into March 6th. And then this also showcases the roughly the late March bottom based on those diagonal yellow trend lines. And so you can see how that called out the bottom in late October, also in late March. So basically, I believe that this whole peak and sell-off will eventually end at the end of March, and that's why the thumbnail of the video says crash into late March. So I think that's where the major bottom is. And let's keep moving. This is one of my favorite models, actually. And again, if you haven't subscribed, please consider it. If you haven't hit the like button yet and you're enjoying it, please don't forget to hit the like button and bookmark my my website or my YouTube channel, blah blah blah. Yeah, please consider forwarding my videos on to others. Thank you so much. This was originally a peak model, but it was kind of the brainstorming session that was supposed to be a peak model, but never really, I couldn't find the harmonic that went with it. But what came out of this was the underlying indicator that was kind of like a zigzag. You can see all the nice touch points that it has. 3 touch points. It calls out the major lows in markets on those 3 touch points or 2 touch points into the center horizontal. So you can see how it called out the early January low. You can see how it's calling out the late March low in markets, and you can also see how it's calling out roughly that February 22nd, 23rd bottom. Now there is a market holiday in there, so I think it will lean more towards the 23rd of March, which I've been told that NVIDIA's earnings come out sometime on the 21st. So it is calling for a major bottom, but leaning more towards the 23rd. But NVIDIA may be the bottom after all. I don't know, but it is leaning towards some type of major low in markets around the 23rd. And then obviously that will lead us into like that March 5th, 6th peak time frame that we discussed, I think, on the previous graph or one of the previous graphs. All right, let's keep moving. So this is just the weekly zigzag with all the different touch points. You can see how it called out the peak at the end of 2019, the peak around September 2018, all based on 3 touch points, right? And then you can see how it called out the peak in late November 2021, and it has 3 touch points, right, to current time, the current day. So to me, it's very interesting. It seems to be calling out a peak here, right? So I would assume that it's inferring, or it's forecasting the pre-Super Bowl time frame for the macro peak in markets. But again, it's just a forecast, but it's the best I can do. Thank you. And again, you can see roughly the 3-4 touch points into the peak that we saw in late July, in August, and then you can see the touch points that are leading to a prediction of a macro market peak here pre-Super Bowl 2024. And again, this is just using weekly data purely in its form. I don't apply an algorithm to break down the time periods within the weekly data. This is just purely the weekly data. But yeah, it's predicting a major peak here. And again, this is one of my original peak models I had, basically using the green wave for touch points for calling out major peaks. And so again, this is also forecasting that there's a major peak in the market roughly here pre-Super Bowl 2024. This is my daily model. I haven't really updated this, but you can see the touch points for the prediction around February 6th from macro market peak. There's 3 touch points on the green line. You can see that the first one being around January 2022, the second one being around early April 2022, the third one being roughly around mid-July 2022, the fourth one being around April 26th, 2023. So that gives you the 4 touch points out to roughly here as a market peak. And then you can see with the yellow trajectory, it's calling roughly an early March peak in markets as well. So I think that's where we see another peak before the final sell-off into late March. But again, this calls out the end of 2021 as a major peak, early April 2022, mid-August 2022, early February 2023, things of that nature. So it's pretty effective with 3 touch points. So that's why another reason why I believe that there's a major peak here, because it has the touch points into early February. And then if you had a difficult time seeing that, I tried to extend this graph out so you can see the touch points going out to the different points in time. So again, it's calling out for a major peak roughly here around the 6th, and today's the 9th. So, but with a macro model, you can only get so close, right? So that's why, again, I try to use micro models to fine tune it. And this is what you saw last time with the 60-minute model. I haven't changed it, so you can even say that the model is calling roughly February 7th in this model. So that was the blast up to 5,000. So we're still hugging about that 5,000 mark right now as I'm making this video. We're about 5,013 on the SPX500 USD. So, but yeah, it's not calling out February 9th, is it? So I think if you look at the bottom in the jagged line out near August 24th, 2023, I think that's how you might get out to roughly now. So it does seem, it's hard to get every angle, every one of these pinpointed, but I think that's where you might be getting this double top. Okay, and then this is a 4-hour chart. And so essentially this 4-hour chart is also calling for roughly that March 5th, 6th type of peak out there. And I think I did have a trend going out to roughly here, but I don't think it made it into this model. So if and when we peak, maybe I'll make it into next week. But you can see the 3 or 4 touch points going out into roughly March 5th or 6th on this 4-hour zigzag wave. So I do believe that there will be some type of melt up into that after the February 22nd, 23rd bottom time frame. And again, this is a 60-minute daily from last week's video. Again, it was roughly calling out February 7th. So you can see why that we got the strength into February 7th. So it doesn't necessarily call out the February 9th so time frame so much, but again, you can see how it predicted roughly February 7th. I think I added this week. This is the 30-minute peak model, and it does seem to call out February 7th is the peakish time frame, so very close to that. Don't pay attention to the very far end of the graph. That's there's a bug in my algorithm I can't really resolve easily when I convert from day to minutes. So that's why you get this little jump up in the wave at the very end of the graph. So that's not realistic, but you can see the trend. This is the 2-hour model. You can see the 4 touch points going out to roughly February 6th, February 7th. Again, that last pop in the graph upwards from the January 25th time frame is fake, so don't pay attention to that. But yeah, so basically just calling out for the peak roughly around here. And this is the 60-minute weekly. You can see the 3 touch points going out again to roughly March 5th, 6th. So those points are pretty well seen. And I would argue that the touch points coming out to roughly here as a peak are also very well seen. And this is weekly data with the 60-minute algorithm, at least what I've labeled as a 60-minute algorithm. So the 60-minute algorithm is also calling for roughly a March 5th, 6th peak as well. So after we get the February 23rd bottom in markets, then we would jump from February 23rd up to March 5th, 6th in theory. And this is the 30-minute peak model, roughly showing the peak around the February 7th time frame that we saw in markets. This is the 20-minute S&P model, basically calling for peaks in the market around you can see I was pretty close to the 7th, and then you might even say it's calling the 7th because the purple wave actually went below the trend line where I drew it, where the number 2 is at the very bottom. If you would pull that line down a little bit, it would get you down to the 7th, 8th. So it was probably calling for more of the 7th and 8th here. But essentially you can see how it called out the end of December, called out roughly February 6th, 7th as a peak in markets or strength into that point. And then you can see how it's calling out roughly around March 5th, 6th for strength peak in markets. Okay, so this is the 5-minute model. Basically, I fine-tuned the green wave because I could not figure out for the life of me how to get the green wave to sync to peaks. And so I saw today, I kind of finally figured, I think what I figured out will hopefully work. Basically calling for melt up peak around into the 7th, and then the yellow dash diagonal hits the top of those 2 green waves into the 9th, and then the purple wave you can see has like that burgundy diagonal trajectory going into the 9th as well, so seeing strength into the 9th. And then you can also see how it called out with those black diagonal lines at the bottom, called out a peak or strength in markets around the end of January, and it's also calling for peak strength in markets around the 5th and 6th of March. And again, I think one of the business days will be removed from this time sequence due to market holiday, so it'll lean more towards March 6th. But you can see how the green wave is calling out March 6th, and you can also see how the black trajectory is calling out March 6th as a peak in markets. So again, markets would drop into a bottom into around the 23rd of February, and then jump up into early March for another peak. And this was just a 15-minute model calling out for some type of peak in markets around here-ish, around the 6th, 7th, time frame. So it seemed to have worked thus far. Markets are still trading. The SPX500 USD, as I'm filming this, is still trading around the 5,013 number. So we haven't really lifted off from the highs of February 7th yet. Again, if you haven't subscribed, please consider it. I realize that everyone's not going to be able to sit down and watch these episodes in full length in one sitting, so I need to throw out the subscription line from time to time throughout the video. And again, if you haven't donated, or it's something you feel like you want to do, you want to support me and want to help me grow my following, please share my work, or you want to donate, you can use the QR codes that you can find in every slide. I hide them in the date section so they kind of blend in. So hopefully people are not annoyed with them popping up in parts of the screen where they can easily see them. But I try to hide them in the date section where it's just black and white and hidden very well. Hopefully you find it as such. Again, this is just the 10-minute algorithm with a 10-minute algorithm with a 30-minute algorithm laid over, or 10-minute period without the 30-minute algorithm injected into it, if you will. And then again, this is predicting a peak would happen. You might argue that was pretty close to the February 7th peak with the 3 or 4 touch points there. Keep moving. So this is kind of what I call a rickety timing model. This is one of the original bottom models I had. Needs 3 touch points. You can see how the model was roughly, for SH is calling for a bottom and shorts around the 6th or 7th based on the 3 or 4 touch points. So you can see how that was pretty accurate, right? Pretty surprising, right? Some of you are probably like, what? That's the most jagged, rickety piece of garbage I've ever seen. But yeah, it got pretty close to the February 7th melt up into 5,000 on the SPX500 USD. Pretty cool, huh? Yeah, so we'll keep moving. Again, this was one of the original peak models I had. It's my 30-second peak model, so it got close to the 7th, right? So you could even tighten it around point number 3 and push it more into the black wave, right? The bending of the wave around point number 3 and make it go out just a little bit more into the 7th. So it's difficult to know exactly how much tightness to apply to the trend line, but you could see how you could get this to press into February 7th for the peak date. So it did pretty well, right, for a model that's this just ease of a black wave, right? Creating a trajectory for a forecast. You can see the data stopped in mid-January, so it's still relevant even to today. The peak is still holding pretty firmly around 5,000. So I thought this was pretty cool. This is my 5-minute time period, and then it has the 30-minute algorithm applied to 5-minute periods, and you can see the 1, 2, 3 touch points in the different colors. The first one being the peak getting called around the 7th, and then you can see it calling out March 5th, 6th. Now I don't know if when I changed the algorithm for the green line, if this is going to change. So just making a note out loud that I may have to look back into this. But the green wave for the 30-minute peak algorithm looks completely different than the just normal 5-minute period algorithm. So you can see why I kind of apply the 30-minute, because sometimes it draws out different facets of the prediction. And then as soon as I catch them, I just screenshot them and throw them in the presentation for Friday or Saturday, the weekend. So essentially that's what I did this week over a lunch period. So hopefully you're enjoying it. This is also, I think, changed, but nonetheless, I think it tells pretty much the same story as anything else would. So again, this is with the 30-minute algorithm. That's what the 30 is in blue. So I may have to set this up where if the 30-minute algorithm is applied to the 5-minute period, it creates the same output for the green wave. But you can see the 3 touch points, right, for the model. So again, this is calling for peaks around the 6th, 7th, and then around the 5th, 6th in March. So I updated this model. This is my Federal Reserve peak algorithm. You can see all the touch points. I think the previous week's presentation I had it all marked up with like 6 touch points. Essentially, you can see it calling out roughly February 7th pretty tightly there. So that's when we hit 5,000 on the S&P 500. So I think that was a nice call by the model. Futures SPX 500 USD is right now at 5,014. So still just 15 points away. So again, I could rock it up into the end of the day, pre-Super Bowl for sure. But I think it did a pretty good job from such a long distance from using data from August 2023 to predict market strength into roughly February 7th. I think it did a really good job. This is the 60-minute daily model. And I think this was the original slide I used for that, so I won't spend much time here. But you can see the 3 touch points I used originally. And you can argue that it was February 7th, right? It's leaning into February 7th, so you can make the argument that it was near February 7th. This is the S&P 500 10-minute period algorithm with a 30-minute algorithm applied. And essentially, it's calling out the February 22nd date pretty pristinely with 3 touch points on multiple purple waves. So I'm not sure what's going to happen into February 22nd, 23rd. But it does propose that there's some type of meltdown or some type of bottom there. It's interesting because here we are just about 8 trading days away from that prediction. And markets have not softened at all, right? They maintain that 5,000 mark. I think futures are at 5,015 right now. So they're holding firmly around that 5,000 mark. But the model proposes after Super Bowl that supposedly there's going to be a significant low in markets around the 23rd. So I don't know how sharp or steep that's going to be. Yeah, so that's where I'm getting the February 22nd, 23rd bottom from. And this is just another way of looking at the February 22nd, 23rd bottom. Same algorithm. I think I'm just using the green wave here. And then this is the 90-minute algorithm, the zigzag. It's also picking out some type of bottom around the 22nd, 23rd. Now, if you remember, if you go up, I don't know, like 30 slides, I think this is slide 45 of many. But if you go up to like slide 15 again, you can remember that the one of the graphs showed a 2 touch points into February 22nd, 23rd. I think that was the peak model that didn't turn out to be a peak model. I can't remember what the time frame was on it. But if you go back, you'll see that in the very beginning when I started talking about October, that it was calling out the same time frame and that all these models are calling out. So again, looking for a major low in markets around the 22nd, 23rd, and then pop up into early March 5th, 6th for a peak. And then again, this is the SH peak model for the Fed algorithm. Again, this is also calling for a peak in shorts around the 22nd, 23rd of February. This is the 30-minute daily purple wave, the MJ23 wave. Again, you can see the 3 touch points going into late October 2023, and then you can see the 3 touch points again going out to roughly March 21st for the bottom. So I think that's where the macro low is going to fall, right around that March 21st time frame. So again, peak here pre-Super Bowl, and then the major bottom would be right around that Fed meeting date in March. And then this is just a different way of looking at it. You can see the different touch points underneath the black horizontal line that seem to call at the bottom of the markets pretty well. So again, you can see that the 2 touch points on the green trend line go up to roughly that late March time frame. So right around the Fed meeting, looks like the Fed could either trigger one final sell-off or bottom, something around that time frame. So I believe that will be the final bottom after markets peak here. If they do, proposing that the models are accurate, peak here and then bottom around the Fed date late March. And then this is the 5-minute model. Essentially, I haven't updated this for a while, right? But essentially, it's still calling out like the March 21st, 22nd time frame for a final bottom in markets. This is with the 30-minute algorithm applied, as you can see with the 5-minute in the little 30 there. So in a perfect world, the markets would hit their final sell-off bottom around March 21st. And again, this is the 2-hour chart from last week, essentially calling out that there'd be a major bottom in late March of 2024 for a major cyclical bottom, so that would tie out with all the other proposals from March 21st for a bottom. And this also called out the end of October 2022, and you can see how it kind of got 3 touch points into the end of October 2023. And yeah, if you look earlier in the presentation, this model, you can find 3 touch points out to October of 2024. So I haven't changed this graph since I think the first week. I have the next graph after this one. It's going to show you, it's going to zoom in on just this bottom rung that this is projecting, but essentially you're using 2 or 3 touch points to predict where the final bottoms are in markets. And you can see how it called out in mid-May 2022, in late June 2022, in the end of October 2023, and you can see how it's calling out for a major bottom in markets at the end of March 2024. And so let's zoom in on just that little section there. Okay, so I zoomed in on that little section. You can see there's actually 3 touch points that go out to the end of October 2023, and you can see there's 3 touch points going out to the end of, or into late March 2024. So I think that's where the final bottom in markets will be for this cycle. If you haven't subscribed yet, please consider subscribing or passing my work on to friends, family, others that might enjoy stock market forecasting the way that I present it. Hopefully you're enjoying it and seeing that I have a number of models that I try to use to forecast where market peaks and market bottoms are, and how I try to keep a very similar forecast week after week. And in order to do that, you'd have to have all your models essentially synced, right? All the multiple models, all the multiple algorithms would have to be synced. So hopefully you find that impressive on that scale, and then you can hopefully enjoy the consistency week after week, and hopefully that's what leads people to share my work. Hopefully it leads people to hopefully find value in my forecast, and then hopefully ultimately leads to better profits, hopefully for people, and then hopefully leads to higher donations, right? And hopefully being able to do this all the time, maybe in 3 to 5 years. We'll see what markets hold for us, and see how aligned the models are. So again, this is calling for a major bottom based on 3 touch points into roughly that February 22nd, 23rd time frame, and then also calling 3 or 4 touch points on the jagged line there, the major bottom in around the Fed meeting. And so this is the zigzag graph based on those 2 touch points on the bottom. Essentially, it's hitting the bottom rung roughly around February 22nd. So the previous graphs were 25 points apart. This graph here is the standard 50 points apart for the black horizontal lines. So usually what happens when you project out here, usually it hits a bottom. So I'm thinking that would be the bottom in markets, would be around 22nd, 23rd for the next low in markets. And then some of you are used to seeing the gold wave. This has 3 touch points. You can see at the beginning of the yellow arrow, it's kind of flat in the gold wave, so that counts as 2 points, and then it bounces off the top of the gold wave around September of 2023. That creates a 3rd point. So essentially saying that the end of this cycle sell-off would occur into late March. So that's where I would expect to see a major bottom in markets. And then essentially I took the 4-hour graph zigzag, and I tried to see if I could see any future forecast by the zigzag. And one could argue that you see a number of touch points going out into late March. So I know this isn't super precise. I'd hope to see better, but it is what it is, and it does seem to have few touch points going out there. So I would argue the case that if there's a major bottom out there, that's what it's trying to predict. And again, if you're enjoying my work, hopefully the major peak in markets does form around pre-Super Bowl for the year, if that one of the previous graphs is accurate. And again, if you want to support, show financial support or donations for my work, again, it's how I hope to go autonomous one day and do this for my full-time job, maybe in 5, 6, 7 years, 3 to 5, 6, 7 years. Yeah. So if you find my work something that you want to support, please consider it. Thank you. And this is just the weekly model that I usually finish up my forecast with. So again, you can see how it has 3 touch points going out into late March of 2024. So hopefully you've enjoyed this video, this forecast episode. I've made it roughly a full hour long. I took up my lunch hour today to record this, so good timing. So if I can just take up my lunch hour to do this every Friday, then that's my goal. Keep it around an hour or less. Right there, though, to create a realistic episode that hopefully you can compare my work to Bloomberg or to one of the other very well-known or worldwide forecasting analysts, or perhaps a really high-end hedge fund presentation where they go on for an hour or so discussing multiple charts, that you would find it a high-end subscription company that hedge funds would have to pay thousands of dollars to get their subscription, their videos. Hopefully some of you feel that that's the value you're getting in these episodes, and hopefully markets hold tight here to this 5,000 threshold that we've seen on February 7th. I don't think the peak call is too has been too far exceeded. I still think the February 7th peak, at least at this time, is still a halfway decent call and close to 100% accurate. Depends on how the day finishes. Right now we're at 5,016 on the SPX 500 USD versus the 5,000 high, or 5,002 high that was formed on February 7th. So I think it's still in a reasonable tolerance for calling the February 7th peak highly accurate. But by the end of today, I could be completely wrong. So we'll have to see next week in the next week's video where the peak for today fell, and then have to give a rating for how the peak call went. If the February 5th through 7th peak window found its mark, or if markets went much higher. So anyways, hopefully you've enjoyed my video series for today and are enjoying it in 2024. Hopefully you're highly impressed with the call in early January for super strength into pre-Super Bowl. And if you are, again, please share my work, maybe even at a Super Bowl party. All right, thank you so much for watching. Until next time, I'm brschultz.